I'm proud to welcome you to a special series of the Exceptional Advisor podcast. Hi, I'm your host, Bob Powell, and over the next several weeks, this special series will highlight exceptional advisors in these extraordinary times. We hope this series helps you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences in light of the unique challenges and emerging norms of the current times. Today, my guest is Brian Hunter of Strategic Capital Allocation. So welcome to the podcast, Brian.
Thank you very much, Bob. Happy to be here. Thank you for bringing me on.
It's a pleasure having you on. So let's start with having you, for the benefit of our listeners who may not be familiar with you and your work, as few as they may be, describe a little bit about yourself and your practice, your business.
Well, our practice goes back to the mid-'80s, and it was preceded by a legacy and stint in strategy consulting at places like BCG and Bain and McKinsey, and a lot of public sector consulting, working with Ralph Nader. But all that was preceding getting involved in investment strategy. And we essentially became one of the early outsourced CIOs back in 1994, thanks to Jamie Dimon, allowing me for my institutional clients to be able to allocate, do due diligence on and allocate into hedge funds and private equity and so on. So we were doing that right up until 2017 for over 11 billion of various institutional assets, institutions like New York Presbyterian Hospital, Partners Healthcare, school endowments like St. Paul's School, Culver Academies, and associated CEOs and trustees and so on. But we then transitioned to what we're doing today, which is building investment products that fill a gap for what people are seeking and cannot find. But all of it throughout has had at the core something that we patented many moons ago, and we branded and called Quatrain. It is a bespoke, dynamic portfolio construction platform, and we like to say no prophecy, just vision, and to try to endow that vision for the benefit of our clients. So that's where we are today.
Great. Well, we'll talk more about that, about QGS in a bit. Here we are. It's July 2nd as we record this podcast, and we're still in the middle of the pandemic. In fact, it seems to be accelerating as we speak, and at least in terms of number of cases. And we've created this podcast series, the Exceptional Advisor During Extraordinary Times podcast series, in part to have advisors like yourself talk a bit about how you've managed your business during the pandemic, and also how your clients are responding during this pandemic. So let's start with talking about the business, if you don't mind, Brian, and let's start with a softball question, if you don't mind, which is, to what degree has your investment in advanced education, including the certifications from the Investments in Wealth Institute, helped you during these times?
Well, everything helps. Education helps and experience helps. The key is, who are you inclined to be as an individual? You can have the same education to two different people, and they will absorb it and use it very differently. My lifetime is a string of handling crisis management situations. So I'm very used to anticipating and dealing with crises like the one that we're in today. It's never comfortable. And whatever we're hit with at any point in time, including recessions, are always different than the last one. But it's a matter of all that is cumulative, and it all helps. We have excellent programs through the Investment and Wealth Institute, and they have been very valuable in terms of background in dealing with things like this. But it's also part and parcel to whatever else we educate ourselves with as we get advanced degrees and undergraduate degrees and the kind of experience that we engage with.
You mentioned experience, and I think that's a key component of what we're trying to get across in these podcasts, which is for those who have been through times, maybe not exactly like this, but who've been through the 2000 recession or the 87 crash, or you name whatever 2008 financial crises, that having gone through those things gives you the opportunity to understand what to expect, perhaps, or what to do in the context of a crisis like we're experiencing today.
Right.
And hopefully your experience will benefit the folks who haven't gone through the same kinds of experiences, or who haven't gone through them at all yet. This is maybe their first time.
Well, I think that ongoing, there's a couple of things that I think should be embedded in anybody's discipline, and do it in a way that it works for you. First, timing the market may be impossible, but dynamically controlling risk is essential. And when you say risk, it's seeing risk as it really is, not as an artificial normal distribution. Risk expressed as volatility is really gritty. It's not smooth. It's bumpy. There are fat tails, positive and negative. And the closer you can see that risk to reality, the better you have a chance of being able to manage that risk. The second thing that we always think is very critical here, because you never can exactly time when there's going to be something like a pandemic. And the pandemic, unlike the 2008 Great Recession, is a true black swan. Nobody could see it coming. We always knew something like that could happen, but there was no warning. And so we have another maxim here, and you and I can appreciate that living in New England. Defense does win championships, including Super Bowls.
Right.
So it works. I mean, just think of it in very simple terms. If you keep the opposing team to 0 points, all you need is a field goal to win the game.
Right.
And it's not relative risk of something relatively negative. The idea is to actually be flat to positive. A lot of people in this COVID pandemic and the market reaction to that and the protests that were unleashed, et cetera, to brag about being down 15% instead of 30, to me, is not a victory. But if the market was down 31 and you're only down 4%, that's a little bit more like what you're really after, in my mind. Defense winning championships. Because remember, if you lose half of your money, you need 100% return to get it all back.
Right.
And how often does that happen in nature?
Not often. Not often. So we'll dive deeper into that and the paper that you wrote in 2013 for the Investments and Wealth Monitor in a little bit. But I'm eager to learn more about how your practice and business was prepared for the current state of affairs. You know, what did you have, and was it prepared, and what kind of technology or human capital or disaster planning or crisis communications or continuity plans did you have in place for what we're going through today?
Well, we're dedicated to making a habit of resilience. And in order for that to happen, the first thing, again, is to embed sufficient defense so that you can win that championship. And so we've designed for our management approach, whether it was as an outsourced CIO when we had multi-strategy assets across the board globally, or whether it's currently a investment strategy that focuses on a dozen ETFs and systematic cash. It doesn't matter what the menu is. The key is embed that risk control and embed that understanding of risk as it really is, as opposed to something that is a distortion of reality. So that's what we did. What we do is our system, our platforms, no matter what the menu, no matter what the client, it's to really fortify the core of the portfolio with those principles. And in doing that, it actually facilitates the risk budget. It facilitates the ability to go out there and to take the kinds of risks and things, and to take the liquidity risk of going to things like private equity and hedge funds that are longer term, not liquid, but can really enhance the bottom line of the portfolio. So fortify the core, it facilitates the risk budget, and make sure that you've embedded sufficient risk controls so that you do not take a big chunk of the downside.
So I take it that that sort of sums up your investment strategy response to the market volatility
Yeah.
that we've experienced in 2020 so
Yes.
far. Yeah.
Yes. Yes. And to put hard numbers to that, our SCA Quatrain Global Solution Strategy, the worst peak to trough this year for the market has been almost 34%.
Right. Yeah.
The worst peak to trough this year has been minus 21.5% for 60/40. And remember, everybody's a long-term investor until they're down 20%.
Mm.
And then, but our worst peak to trough was 10.25. And then the volatility for 60/40 has been almost 31% this year. The S&P, 53.5%. That's huge. While we have had about 15.4%. So that's what we mean by, if you really do protect the core, if you really do control risk, which is critically essential, and volatility, which is risk expressed in terms of volatility and price movement, then it can give you those kinds of benefits.
Yeah. Well, let's turn our attention, I guess, to that, because I'm curious to have you talk a little bit more about the QGS system and what you're using in order to get that kind of performance.
Well, again, what I really want to emphasize here are principles that people can take away and use for themselves and invent new ideas that are better than what we're doing, even. Okay, so this is done in that context. And that was the context that we wrote the article, which was back in 2013, but is as pertinent today as it was then. And so we've embedded those principles. We patented a lot of what we do here and overseas. We have a lot of trade secrets, but it is a systematic approach that says that fundamentals are critical. Now, what do I mean by that? That's kind of like some people say, well, Brian, are you, a vegetarian? Well, I said, well, kind of quasi. Well, what do you mean? well, I do eat beef, but it's grass-fed beef.
Yeah.
Okay, so the key is that 24/7, everybody around the globe happens to be doing their analysis of what to buy and what to sell, and they're doing their analysis of how they value everything, and it's skewed to their own prejudices and their own insights and their own analytics and their own needs and their own conflicts of interest. But all of that, all those fundamental drivers and fundamental analytics distill into a closing price at the end of the day, don't they?
Mm-hmm.
That's it. So fundamentals, I think, are critical. And those fundamentals are embedded in the closing prices. So we like to take the closing prices of anything that's in our menu of investments. And that's what we that's the input into our algorithms. And we are looking at the path, the pattern, the co-movement of those prices. And the idea is to avoid what we like to call blend anxiety. People that like to throw around complex words call it covariance or even dynamic covariance.
Yep.
But, blend anxiety. Think of, a lot of people may not remember Mel Brooks, but I love Mel Brooks. Blazing Saddles and
I should hope people remember Mel Brooks.
yeah, and High Anxiety. High Anxiety plays a psychiatrist who is incredibly frightened of heights, and he's sitting there in the Hyatt Regency in San Francisco that nobody can go to anymore right now. And so we said, well, great song behind it, High Anxiety. Well, we want to avoid blend anxiety. What does that mean? Putting together two or more investments that give you a massive anxiety during a downturn, that they both go out of whack and both go deeply down at the same time. A, they're highly correlated to each other. They move in the same pattern. And B, when one is down 50%, the other one's down 50%. To me, that's a lot of blend anxiety. On the other hand, if you have two investments together that never give you a downside of more than 10% ever, that's low blend anxiety. So the key is to find a way through the path, pattern, and co-movement of those return streams that distill all of those fundamentals from around the world in closing prices at the end of the day, to minimize that blend anxiety. That's the first step of what we do, is risk control. And then we have a vision of what is out there in terms of long-term, a strategic view, and then we have a tactical view. We want to be strategically visionary in terms of our time horizon, but we also want to be tactically agile to avoid deep downside. And we combine those things, filtering out noise. And then we say, hey, we don't necessarily cover everything. What's the intrinsic risk and volatility in the portfolio? And if it's above a threshold that we find uncomfortable, then we will prorate into cash as a safety valve. So it's that 4-step process that we take in terms of managing money. And so far, it's working.
So I'm looking at one of the PDFs that you sent me, and there's a table there that looks at allocation insights, and I guess it speaks to what you just described. The allocation to cash as of year-end 2019 was 0, but as of May 31, 2020, you had gone up to 31.2%.
Well, actually, yes. This year started out where, again, we also have a max, and we're willing to give up the peaks to avoid the valleys. Mm-hmm. So when the market was on fire early this year, January into February, we got about 67 to 70% of that upside. And so we had no cash, as you said. We had a big exposure going into the year in terms of consumer staples, big exposure to healthcare and to treasuries. And believe it or not, we had a big exposure to the market itself, to the SPY, mm-hmm. SPY. Yeah. In fact, we had 22% going into the year, but it went up all the way to 37% by the end of January. That's a pretty big exposure.
Well,
we still know this. But then, as you noted, COVID started to hit. But remember, this is truly a black swan. Back in the financial crisis, Quatrain had the vision to see things coming down the road. I'm not kidding, 2 years in advance. 2 years in advance, we were taking massive risk off the table. We had some pretty powerful people sitting around our conference table in New York. We had John Thain running, president of Goldman Sachs, sitting there, and we had John Mack from Morgan Stanley, and we had Dave Kamansky, who had headed Merrill Lynch, Lionel Pincus of Warburg Pincus, father of private equity in this country. We had some pretty sharp people, but they all came to that table with the insights, maybe even prejudices of their internal chief investment officers. And at the time, they were all massively adding on exposure to beta exposure. We were doing just the opposite. We were 180 degrees out of phase with that. And they voted unanimously to go with what we were doing, partly because they had experienced us during the dot-com crisis. And during dot-com, the market was down 10% 2 years in a row, if you remember, 2000, 2001, and down on average about 27% globally in 2002. Over that period, we had several billion of institutional client assets, all of which made money. And that was because we were controlling risk. So we did it again there. We saw it coming in advance. But COVID, you could not see some of that risk embedded in the path, pattern, and code movement of the return streams. Those fundamentals were not there. It was truly a black swan. So now the question was, well, how agile can you be? How quickly can you move out of the pocket with the defense coming at you and still make a pass down field to make the touchdown or to get a first down? Mm-hmm. And that's where Quatrain was nimble enough to be able to rapidly respond. And by the time we hit the 25th of February, we had gone from almost zero utility exposure to 42% utilities. Still 32% in consumer staples, but we had moved treasuries, TLT, up to 25%. By the time we hit March 16th, March 10th, we were adding cash, and March 16th, we had 55% cash exposure. We hadn't seen that much cash exposure since 2008. So it was a matter of being able to rapidly see that risk in the data itself, in the fundamentals, and rapidly adjust the portfolio. That's important. Agility.
Speaking of TLT, at least as of May 31, it was close to 50% of the portfolio, which is also noteworthy, I suppose.
Yeah. Now we're down to about 17% cash. It's very interesting. Now we're down to about 17% cash. Just to give you an idea, we're down to about 15% cash. We're about 37% exposed still to TLT, to long-term treasuries. But QQQ, innovation, about 38%. Consumer discretionary, consumer discretionary, about 6.8 and 4.2%, and consumer staples. The portfolio has got a sense that there is some upside in the markets, and we're experiencing it yesterday and today.
All right. So let's just go back to your business for a second. In terms of employees, I suspect everyone was working remotely during this pandemic, and perhaps even still.
Yep. Well, we're very used to that too. When we were an outsourced CIO, our due diligence on managers was very forensic, and that required on-site. So we were constantly going deep into China for our private equity investments and distressed fixed income investments over in Asia, literally around the world. So we had to be very, very mobile, and we had to be able to be mobile and effective even when we were remote, and constantly on site with clients in places like New York and Chicago and elsewhere. So going into this crisis, we were already embedded into that pattern of behavior where we were very effectively remote, and now we're basically 100% in the cloud. I remember working effectively on things in a boat floating around Capri.
We are in a new world order, I suppose. I wonder what the future of commercial real estate will be, but we could save that for another day.
Yeah.
So any thoughts about, like, now that we're at least 3 months into this pandemic here in the States, at least, any changes? Do you anticipate making any changes to the business or practice going forward? Did you notice anything where there's room for improvement, or there were gaps that need to be plugged? Yeah.
There's always room. Yeah, sure. Always room for improvement. And the first step in all of this is to be aware of what people are going through. And most people are not me. Most people are at home, and suddenly they have to learn how to be the chef. And they have to be chef not to themselves and a significant other, but children of varying ages. And children were not designed in our culture or any culture really to be embedded in a home. They're supposed to be interacting with other children and being outside and doing sports and being imbued with culture and being able to do music and art. And all of that has come to a grinding immediate halt, and it's broken their pattern. And there's tremendous anguish going on there, tremendous impact and potential damage. You know, we talk about PTSD, post-traumatic stress disorder, in people that are exposed to a war. Well, this is a kind of war. People are under de facto house arrest. And it's not PTSD, it's MTSD. It's not post, we're in it. It's middle traumatic stress disorder. And this has an impact on decision-making. The emotional trauma that is going on right now is unprecedented. Thank God we do have. I remember when I was growing up, we had, just 3 or 4 TV channels and rabbit ears
with a little aluminum foil to just to help a little bit. Yeah,
exactly, right. And sometimes all you got was the test pattern. And some people dress today looking like a test pattern. And today, thank God, you have hundreds of channels and ways to divert attention and to entertain, and we still have these issues. because people were not designed to be sitting under house arrest. So the first thing is to be empathetic about that reality and how difficult it is for people to focus, to really do what they prefer to do in terms of their own levels of diligence. And it's just hard for them to be aware, to put it into, some kind of rational perspective outside of their MTSD. And
Sure.
if I can use that now, and then to be able to make decisions that are critical to their future. So yes, in terms of changing, it's a matter of being first aware of that and expressing and touching that with clients and prospects, and going through that with them even more than talking about investments themselves, because what investments that they can put into proper perspective and evaluated is going through this MTSD filter that everybody has to some degree right.
I take it the same is true for employees of the firm, that they too are going through the same thing that their clients are going through in many respects.
Exactly. Everybody. So it's a matter of, that's why Zoom is picked. Let me tell you, the competition to things like Zoom, it's going to advance. That technology is going to advance. And here's another thing. It's said that psychologically, anything you do for at least 17 days in a row becomes a pattern. Well, people now have a pattern of working remotely. And in places like where you and I live in the Boston area, and especially New York, people just didn't like mass transit, even when there was not COVID. You had people coughing and sneezing and banging up against you, et cetera. People just didn't like the commute. It was like dying an hour and a half each way every day. It's a sort of death. And instead, they're at home and they're more productive and they're happier. And instead of spending $20 for lunch or $30 for lunch, it's maybe 80 cents for a roll-up from Costco. That's better than what you buy. And you're there. Although my wife has gotten very, very used to mentioning my name followed by a chore.
The honeydew list is growing. Yes, I know.
I'm going to redo the movie Help. I'll be the star. And so, this is, people have gotten used to it and they say, I like this. And the productivity of the companies are not suffering. They've, in some cases, improved. And so the sense of what is a workplace and coming together, which there still is nothing like sitting around a table with a whiteboard and imagining something. But to some degree, we can start to do that technically. But to be able to read people's body language and sense who they and what they are and what they're really thinking behind the words, so that you can ask the next most appropriate probing question, I think that that's second to nothing. And we still are going to have that. But the way in which we come together and how and with what purpose is going to definitely start to really change. And big firms, even like Morgan Stanley, announced, we have to rethink our footprint. And they are actively as we speak right now.
Others too. I think Goldman Sachs has announced plans to maybe reconsider its footprint too.
Yeah, and everybody was waiting until after Labor Day to even come back into these offices. Formally, it's been declared they're not coming in until after Labor Day at some point.
Well, logistically, to get people into a building, there was an article, I think, in this week's Wall Street Journal about Chevron and how the challenge that you have bringing people into an office tower, whether it's elevators or lobbies or mass transportation, to get them there. Just a huge challenge. So,
oh yeah, they go into my building now, the Prudential Center. They take your temperature. So as I came up, I said, "Would you please take your temperature first?"
It's interesting. My
I just want to know the person taking the temperature wasn't exposed, wasn't somebody that could, they got to come up pretty close to take my temperature. I wanted to make sure that person was okay.
Just as a side note, my daughter is working as an intern for a Boston-based company that builds robots that take someone's temperature, and they're being deployed in office buildings and maybe sports arenas like Fenway and whatnot. Yeah.
That's cool.
It's great.
Yeah, because the person that was taking my temperature could be described as a kind of robot.
So we've talked a little bit about your clients and how they're doing performance-wise, and you've sort of mentioned how they're doing emotionally. I've spoken to some advisors, and when they talk about how their clients are doing, they also talked about how their clients were almost prepared for this in terms of having a plan in place that would withstand the kind of volatility that they're experiencing. Do you find that to be the case with your clients, that they had a good understanding?
Oh, totally. When I was talking, I was
Yeah.
talking in general. When I call up my clients, they always say to me, because throughout the years, they've never experienced a deep downside with us. So when I call them up, they go, "Why are you calling?"
Right. Well, that's good news then, right?
So they're very comfortable because they get to see this in real time. They're in separately managed accounts, and they also have the long-term experience. Typically, they're someone that was part of an institutional client that we had. And for one that was a school endowment over 15 years, we, in 13 out of those 15 years, met or exceeded their customized benchmark or an 8% return in all but two, and two we just missed. So they were used to us controlling that downside and not having to worry about it, not having to think twice about it. We kind of had their, and this was a military school background, so they said, "You always had our six."
Yeah.
That's the expression.
So I take it too, then, in terms of how people react emotionally to volatility, not maybe in their personal portfolios, but if they look at what the S&P is doing, or what other investments are doing. Obviously, they live in a world where things are emotions could get the better of them. I take it that you've been able to dampen some of that emotional reaction and whatever cognitive biases they may have as they think about the plan that you have put in place for them.
Yeah, because ongoing, we've always worked with clients so that they would understand that the S&P really has nothing to do with them. And frankly, neither does typically
Yeah.
60/40. All of our clients have always had an absolute objective of some kind. If they were an endowment, one, the endowment had to be preserved, and two, the endowment had to support the ongoing, through withdrawals and distributions, the ongoing work of, say, a school or a hospital. And so it was the absolute objective that mattered, not what the market was doing at any point in time. And that's an ongoing education process, an ongoing process in terms of that empathetic engagement.
So as you think about younger advisors who are perhaps members of the institute, maybe recently were awarded the CPWA or SEMA designation or the RMA designation, and who might be grappling with how to deal with their clients, any words of wisdom for them?
Yes. Get the upcoming issue. I think it's the November-December issue of Behavioral Science of the Investment and Wealth Monitor. And in that issue, I believe we will be publishing an article by Michael Falk of Focus Consulting entitled Everything. Everything you need to know in very simplistic terms. It is probably the most succinct, straightforward, simple guide for a philosophical and practical approach to managing money and managing your clients through that process. I think that will be an important must-read issue with other great articles, but that one in particular.
I have a draft of this in front of me, thanks to you, and I also have planned a podcast with Michael. We haven't set a date or a time yet, but he's on the agenda.
Great.
So thank you for that.
Great.
Thank you for
My
that.
pleasure. My pleasure.
Let me go back to clients and sort of client retention in this environment. Obviously, you've talked a bit about the manner in which you've been communicating. Can you talk a little bit about, I don't know, the use of Zoom calls? You mentioned a second ago, emails, frequency of contact. Are there things that you've adopted in terms of communication with clients that weren't in place before the pandemic and are now sort of routine?
The answer is nothing that we are doing today was not in place before. We've always had a habit. Whenever there's something that is stressful out there, you contact and get together with your clients either over the phone or through Zoom or face to face as soon as possible before anything can embed in their psyche and their decision making process outside of what the universe of what they're doing with you as well as within it. So be ahead of the curve always. If you have any anticipation that something is coming down the road, talk to them before all hell breaks loose, and even as it's breaking loose and ongoing. Contact is critical. Communication is critical. Engagement is critical. And when somebody said, what is leadership? My favorite definition of leadership is engagement and accountability. Engage and be accountable.
Good words of advice. They mirror something that I used to say about management, which was access and advice. So
Yeah.
as you think about where we are right now, are the thing, and you sort of started the conversation by saying, the importance of learning. What have you learned about your business, your practice, your clients during this period that may have taken you by surprise, if any?
Nothing with my clients has taken me by surprise. I am surprised that more people aren't. You and I were talking in a separate conversation about being able to lead a horse to water, but you can't make him drink. We have been trying to imbue people with some concepts that they could take to create even better tool sets out there to help them engage and interact with their clients. And I'm amazed how people are stuck in a kind of echo chamber. And more so the people that are supposedly creating product for those of us out there trying to deliver product to our clients. We're not seeing any real innovation. We're just seeing, concept du jour. Okay, like risk parity.
Right.
And how come we're not talking about that anymore? And there's a whole string of concepts du jour that everybody used and loved in the language, and it was the greatest thing since sliced bread. And then suddenly they disappear because they really don't work. They're not real innovations. They're just another way of packaging the same old thing. Even Markowitz with modern portfolio theory, the key concept there is diversification. He didn't invent that. And in fact, you have to go all the way back to in terms of the first place I've ever seen it in writing was in the Babylonian Talmud, about 500 BC. And it said, let every man divide his money into 3 parts and invest a third in land, a third in business, and a third let him keep in reserve. I mean, is that not diversification?
Yeah.
Dynamically uncorrelated real estate, equity, and cash is a strategic call option on opportunity.
I'll have to go back and see if Markowitz actually put that in his footnotes as a source.
He didn't. I asked him.
Well, he should.
That was something that was mentioned by Alexander and Eischen out of Switzerland, by the way. And he did that on the heels of Mark Evans at Goldman Sachs declaring MPT officially dead. And it's interesting because Goldman is the home of Black Litterman, and I've known Litterman since high school. And, they're modeling as good as it is at Goldman, the Black Litterman model. It has similar assumptions of normal distributions going into, their estimates. So from across the industry, thousands and thousands of PhDs are out there, but they tend to all be stuck in this echo chamber of, at some point, making assumptions like a normal distribution, which is nowhere near reality.
Well, this is a good time, I think, to do a deeper dive into the article that you wrote for the Investments in Wealth Monitor back in 2013, 7 years ago. The title was The Reality Linking Investment Selection, Dynamic Asset Allocation, and Risk Management. In it, you refer, obviously, to the Babylonian Talmud and the first principle of diversification noted there. Um, well, two things. One is we could talk about why you got very little feedback on this, but I think more importantly, to start, I'd be eager to have you walk us through some of what you wrote here and some of the key takeaways, so we can entice people to read it and download it from the Institute's website.
Yeah, thank you. We really, I appreciate that. We're very proud that the Investment and Wealth Monitor editorial board voted to award us the high honor of the Kessler Award for the best article that year. And many thanks for that honor against really great articles that were written. And so we're a little confused that we would win that award but have so little feedback, because the intent of the article was not to win an award, but to really pave the path of innovation. So other people could come up with things like what we've been doing that have been quite successful, that could be as good, if not even much better, and deliver better things for what clients are seeking. Almost 6 years after that article, last year, Cerulli Associates, and I'll be getting back to the article on this, Cerulli came up with a piece that was included. When you get your Investment and Wealth Monitor in the mail, you always get typically a Cerulli piece with it. Right. And last August, we got a piece that was really marvelous. It was looking at what advisors and clients are seeking and couldn't find. And the number one thing that they were seeking and could not find was downside protection. And that was, 9 months before the crisis was full blown here with COVID. Number two, it was a tie between better income and reliable income and uncorrelated returns. So after this article, trying to help people innovate in a way that could be very useful, people have been talking a great game, but they haven't been delivering on that game. It's kind of like, where's the beef?
Right.
And so we wanted to give guidelines, and that's what it was all about. And the article spells them out. Investments don't follow conventional bell-shaped return curves. You got to look at reality. And volatility, is not a good proxy for risk. It goes well beyond volatility, and it's the nature of volatility. You can have two people with the same standard deviation. One with that same standard deviation might have all those returns skewed to the negative side. And the other person with that same standard deviation can have all the returns skewed to the positive side. It's kind of obvious which one would you want. And also, volatility isn't constant. It's something that's moving over time. So you can't be static. You've got to be dynamic. And even correlations are not static. Remember, we were talking about blend anxiety? That blend anxiety, none of that is static. You can't think in a fixed perspective. You have to think in a nonlinear, dynamic perspective. So let's take that to the Sharpe ratio. Everybody looks at Sharpe ratio, right? But if you take a look at the Sharpe ratio, the longer the time frame of the Sharpe ratio, the less useful it is in my mind, because it's masking over periods of time that could really harm you. It gets washed out. It gets normalized. So what we came up with was something that we call the reliability ratio. The word is reliable. How much value is something being added, and how consistently is it being added over time? Wouldn't that be a useful measure? Something dynamic instead of static. And so what we do is we take that same Sharpe ratio, and let's say we take 1 year Sharpe ratios, and instead of giving you a static 5-year, we take rolling 1 year Sharpe ratios over those 5 years. You have dozens of data points now, dozens. You take the mean of all those Sharpe ratios, divided by the variability of those Sharpe ratios, and multiply it by the skew of the upside. Now you have a dynamic measure that is telling you, and looking at one investment versus another, which one is really adding value and how consistently it's adding value over time. Make sense? So we were embedding these concepts for people to be able to go out and innovate beyond what we have been doing. Look at things like upside optionality. Look at things like drawdown and recovery analysis. Look at correlation ranges and their elasticity. And look at the analysis of incremental risk tail loss versus enhanced potential of achieving a target. So it isn't just the elasticity of your approach, it's how rapidly, what's the velocity of decay? How fast can something harm you? What is the velocity of recovery? How fast can you recover? It's not just that you can recover from something, but if you do it in 6 months instead of 30 months, that's a difference, isn't it?
Mm-hmm. Very much so, right.
Okay. Yeah. That's what we were covering in the article. That's what we're trying to accomplish.
All right. So there's one question I have in the article where you talk about volatility is not a good proxy for risk. You do mention what you think is a better proxy for risk, the worst peak to trough drawdown.
Yeah.
And do you want to talk a little bit about that for the benefit of our listeners who may not be familiar with that?
Yeah. Yeah, I think I mentioned it before. The worst peak to trough drawdown, there's a common saying. People say it to be funny, but it's really, really very serious. Everybody is, quote, a long-term investor until they're down 20%. They typically take the loss. They get out. Some people had the courage to hang in there, and they were rewarded with a lot of recovery through the COVID. They're quite fortunate for that. So far. But the key is, that there was that worst peak to trough, and a lot of people took the permanent loss. So really, that's your real exposure. Permanent loss of capital is the real problem. And most investors don't have the psychological stamina because they don't have a system and a process that reminds them of reality to not take that loss when it goes in excess of 20% and making it permanent. So that's our sense of that.
It's interesting. I'd be curious for your reaction in the Institute's retirement management advisor designation. There's a great emphasis placed on risk capacity and the sense of identifying what dollar amount of money, not necessarily what percent declines you could withstand, but sort of what dollar amount you can withstand to lose before it would affect your retirement income plan, your standard of living.
Yep.
Be curious for your thoughts, reaction to that as a
we actually wrote an article that was published by IWM on that because we, very similar to our other work, we felt that what was important had to be unique to a client's holdings now and in the future and what they could deploy, and understanding what they need in retirement to live on with a assumed inflation rate and an assumed depletion rate on their assets and assumed return on those assets, and how all that impacts their cash flows from now going out 10 years, 20 years, 30 years. And so you have to spreadsheet that in a way that fits the client so they have a good sense of what they want to do or not do today with their portfolio, if anything. And so we did publish that article, and I don't remember, I don't have the actual title of that, but it was in, I can get back to you on that so that you can mention it.
Okay, fair enough. Well, we've covered a lot of ground, Brian. Anything you want to add that we haven't touched on, or anything that we've touched on that you'd like to reemphasize?
Just believe in yourself by believing in reality and dealing with it as it comes at you, and be honest about it and be engaged with your clients. And remember, it's empathy first.
Fantastic words of wisdom, Brian. I want to thank you for being on the podcast, and I hope that you'll come back on and we can have another long discussion about the next topic.
Looking forward to it, Bob, anytime. Thank you. Thanks for having us.
My pleasure. Thank you for listening to this episode of our special series, Exceptional Advisors in Extraordinary Times. My guest was Brian Hunter of Strategic Capital Allocation. If you've enjoyed this podcast, then don't miss our Exceptional Advisor webinar series, hosted by Tony Davidow, available at investmentsandwealth.org. Stay up to date and have the latest episode delivered straight to you by subscribing through iTunes, Spotify, or wherever you get your podcasts. The Institute stands ready to help you as you navigate these turbulent times with new resources, research, programs, accommodations for candidates and certificates. For more details on resources available, visit www.investmentsandwealth.org. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. The Investments and Wealth Institute has been helping investment and wealth professionals become exceptional advisors for over 30 years. Please visit us at our website at investmentsandwealth.org to learn more about our certifications, conferences, online learning, and continuing education programs.